Welcome to the Wells Fargo Monthly Economic Outlook. I'm Sarah House, and this month I'm joined by my colleague Michael Pugliese to discuss recent developments in the economy and how that's affecting our expectations ahead. So, Mike, a key theme that we've seen this year when it comes to the U.S. economy is the resilience of activity in face of the Fed's very aggressive tightening campaign over the past year plus. Has this story changed at all in the past month or so?
Yeah, well, when it comes to what we're tracking right now for economic growth in the third quarter, Sarah, I think the answer is no. We continue to see pretty solid economic growth despite all the headwinds facing the economy right now. So as the data have started to roll in for the third quarter here, we're tracking something along the lines of 3.5% or so for real GDP growth in Q3, which, if realized, would be the strongest pace we've seen this year. Now, the drivers of that have been a little bit of residential investment, as we've seen the housing market pick up just a bit in terms of activity and output there. But the big driver's really been on the personal consumption front, where households continue to spend at a pretty solid rate. What I think it's important to understand is that right now what we're seeing is pretty flat real disposable income growth in the third quarter. And what that tells me is that we're going to need to see some slowdown on a go-forward basis, because you're really seeing households rely on dipping into savings, taking on more debt, relying on their balance sheet to sustain that pretty strong consumption growth. As additional headwinds come into play, not just the Fed's rate hikes, but also student loan payments restarting and some other factors like that. So I think to continue this pace of economic growth, you're going to need to see a really strong labor market going forward. And maybe I'll pass it back to you there, Sarah. How is the labor market doing right now, given the headwinds there?
So overall, we're seeing the labor market hold up pretty well, but we are seeing at least some signs of softening. So you can see that with hiring having downshifted over the past few months. You're also seeing it in terms of fewer job openings, so seeing that demand side weaken. Importantly, though, it seems like that softer demand, though, it's really coming in the form of new workers rather than lower demand for existing workers. So, for example, layoffs have stayed very low. And we are seeing the unemployment rate rise, but it's really come from higher labor force participation. And so that's also helping in terms of more people getting a job and getting at least some income from the labor market. But there are cracks that we're keeping an eye on. So, for example, you've seen temporary hiring has fallen over the past 7 months. The average work week length is back to where it was before COVID, suggesting that businesses are using workers less intensively. But when we step back and we look at the overall labor market, it still remains tight. If you look at it from a level basis, for example, you're still seeing a very respectable pace of hiring. The unemployment rate is still very low. Layoffs are exceptionally low. And I think another way we can see that on net, the jobs market is still very strong, is you're still seeing wage growth at a pretty strong rate. So if you look at the most recent run rate of employment costs or average hourly earnings, they're still comfortably north of 4%. So that compares to a peak rate of closer to 3.5% in the last cycle. So we think that the labor market is still adding some inflationary pressures, even as we've seen things soften up a bit.
So what have we seen soften up there, Sarah? The inflation side does seem like it's cooled some over the past few months. What's driving that, and what's the outlook for it ahead?
So I think we have seen some progress on the inflation front. So, for example, we've seen the core PCE deflator slow to under 3% annualized rate over the past 3 months. And that's being driven by a couple factors. So one, we're seeing goods deflation more recently here, at least when it comes to the core, as you're seeing things like some give back in vehicle prices, other goods as supply chains normalize, and you're seeing some of that pass through. You're also seeing a slowdown in shelter costs finally feed through into some of the official inflation measures. And we think we can kind of maintain that slower pace of inflation over the next few months. So probably keeping that core PCE at under a 3% annualized rate. But in terms of getting it all the way back to 2%, I think that still remains touch and go, particularly as we don't think we can see goods prices decline indefinitely. And I think as we move through 2024, we'll actually probably start to see those shelter rates of inflation begin to pick up again. So we've still got a long haul to get inflation all the way back to the Fed's 2% target on a sustained basis. So with that in mind, Mike, maybe it would be helpful for you to explain what we're thinking in terms of where the Fed goes from here, given this juxtaposition of a still very strong economy in terms of the growth numbers, but at least some softening in terms of the labor market and inflation data of late.
Yeah, I think the Fed so far has to be pretty happy with how things have developed over the course of this year for the most part, as the real side of the economy, output, and the labor market have hung in and been resilient while they have seen those softening price pressures that you mentioned, Sarah. And I think on a go-forward basis, the case for additional rate hikes is pretty weak right now, as we've seen, the Fed get the Fed funds rate well above kind of where we're at on underlying inflation. You mentioned kind of the core PCE inflation slowing to 3% or so over the past 3 months. So I don't think we're looking at any more rate hikes, whether that's at the upcoming September meeting or the other remaining two for the rest of 2023. I think the question more for us is how long will they sit in these pretty restrictive levels? And then once they do begin easing, what does the pace of that easing look like? And our base case right now is once we get to about the spring of next year, you're going to have seen inflation come down even more, and you're also going to have seen the economy decelerate from the pretty strong pace we've seen over the course of the past several months. And that's going to give you an environment where the Fed starts easing policy, probably slowly at first, maybe just 25 basis points at the kind of initial cut or two, and picking up a bit of a pace in terms of those cuts from there. And we've got the Fed funds rate finishing 2024 a little bit above 3%, which would be a material amount of easing from where we are right now, a little more than 200 basis points, but would still be above the peak rate in the 2019s, and a signal that we don't think, even if the economy does experience a mild downturn in the first half of next year, we don't think we're headed back to the 0 or even 1 or 2% Fed funds rates that were pretty standard in the 2010s. So no more rate hikes. I don't think. That's certainly not our base case. Easing coming, probably not imminently, but in the first half of next year, and cuts that pick up pace a little bit as we get into the middle part and second half of 2024.
Well, thanks, Mike, for joining me. And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.